Hello everyone, Rich Zeitz here from Bravias Financial, and welcome to this week's installment in our series, Retirement Investing Pitfalls. This week I'm going to cover pitfall number 4, which is underestimating market risk by not properly diversifying. As you probably know, a disciplined approach to your money can help buffer you against turbulence and uncertainty in the markets. Obviously, there are plenty of approaches that you can take to investing for your retirement, and there are also a number of pitfalls that can interfere with that approach. Underestimating market risk and not properly diversifying your investments is one of those pitfalls. Now, while the stock market has historically offered better performance than other asset classes, such as government and corporate bonds, this type of performance does come with a drawback: higher risk. And of course, it makes total sense when the following investment principle is considered. Along with the potential for higher returns comes the potential for higher risk. I've met with many retirees over the years who are, in my opinion, overly aggressive and have placed a substantial portion of their retirement savings in riskier market-related instruments. Now, by doing this, they run the risk of market crashes adversely affecting their retirement income plan, because there's often not enough time for their investments to come back from the big declines. Now, while there are many variables to consider when addressing risk, like time horizons, risk tolerance, goals, and your other assets, you really want to aim to achieve an appropriate balance of risk in your investments, which I do discuss in more detail in my book. This is why I think it's crucial to understand when planning for retirement, simply diversifying among different stocks or ETFs may not be sufficient, especially if all those investments are part of the same market sector or asset class. You see, diversification is simply a risk management technique that involves spreading your money amongst many different asset classes and investing into a wide variety of financial products within those asset classes, with the ultimate goal of preventing your entire portfolio from suffering losses all at once. This strategy should help smooth out portfolio volatility over the long haul. Now, another important aspect of becoming fully diversified is to invest in global markets. This enables you to reduce the risk of U.S. markets underperforming overseas markets and possibly hurting your overall returns. Global diversification has also been proven to lessen a portfolio's volatility, meaning that it shouldn't be sensitive to returns from any single market. I know the idea of diversification and asset allocation can often seem confusing and a bit overwhelming. Perhaps getting more education on these topics by sitting down with a financial advisor may help you better navigate these waters. That's all for today. Our next video will tackle the 5th retirement investing pitfall: recency bias. I'll see you next week.